All right, welcome in. I am Ryan McGough, the bodybuilding businessman and entrepreneur, real estate investor, whatever one of those things. I am the bodybuilding businessman and real estate investor. And thank you for your time. Thank you for coming in. I appreciate that. If you get something out of it, please like and subscribe to the video so I can put more stuff out that will be helpful to you. That's what this is all about. This is the real estate division of my podcast. This is at the Real Estate Renovator. And I'm excited. I did a podcast for somebody else this week too. It's called the Get Diversified podcast with a friend of mine, Jacqueline. And I will post that up as soon as I can. It was great to do that. It was great to be there. It's great to help and give back. It's really the fundamental part of this whole thing. I think a lot of people miss is that to have anything and really be successful in anything, we have to give it away. We do. It's the one thing I've found in life that really works for everything. And today I wanted to talk a little bit on that same line of what we talked about on her podcast is risk mitigation and diversifying, man. We at my companies, both of them, I have really found out, and look, the truth is on some things, sometimes you have to realize maybe we're doing some things wrong. I'm not saying always be ready to shift gears and always be, what about this thing? What about that thing? What about this? Right. But I think there really is in the beginning, just getting intentional and just doing it. Right. And for us, that was flipping houses. We tried to do some rentals and do some other things, and it stung a little bit, when there was a lot of contracts a lot of sales of flips that were pushed out. We had those big 3 ones in January, right, that we got, and there was a lot of content that I put around those. We sold the first one. It got extended a bunch of months. They put a bunch of things in the inspection reports. Right now, I'm seeing that it looks like a seller's market, but there's very much, I don't know if it's everywhere, but in the DC metro, like maybe it's the inspectors are getting in trouble or like whatever, but I'm just seeing a lot of crazy things going on. Look, I get inspection reports, I do, but to the extent where the inspectors are saying as not Class A contractors or not contractors that are, qualified in all of these different fields to be recommending, putting their opinions just out there left and right. And so it's kind of, I don't know if everybody else is seeing that in the flipping world, but it's very much delaying closings, making, 10K of new work that really didn't need to be done, right? I mean, at the end of the day, flips are not new construction. So you can't go in and just expect that every single thing is going to be done. It's completely redone. If we didn't need to do something, there's no way we would open up this wall and redo, insulation or wiring inside of it. So trust me, there's a level of stuff we're doing. We're doing it, a lot of stuff, but we can't overdo everything to the point where it's a brand new house if it's a 1940s or 1950s or whatever house. So it's kind of made me rethink a little bit as to where we want to be in the future, because when that happens and we have 3 flips, for example, which is our goal per quarter, we have 3, 2 of them get delayed from permitting. There's extra interest that hits. We get a contract when it goes for sale. Now it's at the 3 months timeline where we really want to be at. And this process of delaying the closing goes another 3 months and adds 10 grand. That is another 20 grand in the process of the sale now that we did not want to happen, or it can totally change the entire deal. And then if there was in that process we had to do 10K of work and we get negotiated down, now it's it's not even about profit at that point. It's just our healthy margins have now been negated down. So it adds a level of risk. And when you do that and we say, okay, well, we're going to sell this one in March, we're going to sell this one in February, we're going to sell this one in June. We have a plan for it, and the costs are all allocated to that. When these delay and it's like 1, 2, and 3 at one's supposed to hit, well, now we get paid back for everything we just supported. Now at the end of the day, companies early on are very much operating on slim margins, if not operating in debt for a little bit until we get, they get a full stream of projects and income that kind of skyrocket out of that, like, get it, pay the bills, get it, pay. So it's a very high risk environment. Even if you know what you're doing in flips, even if you know construction really well, like I do, like we do, we've always been great construction managers. We always budget well. All of our numbers are right. Like, we're like, if we do this, we're going to sell for this, right? All of that was right. But when it was supposed to be in 3 months and now it's in 6 months because of permitting delays and extensions on the closings and, negotiating down a buyer friendly inspection report, it's not, it's just telling you something, right? And so we felt the sting with that, and having some rentals and having kind of all these things going on at the same time, projects pushed out. We got really lean for a little bit, and it just kind of, it kind of pushed me to the point of, okay, well, wait a minute, like maybe there's something else here, something else that can be done. And so when these things start to happen, it's great to find and understand like what is going on and how we can change it and how we can adapt to it, to the environment. Because I very much think it's always important to stay out in front of trends and things that are going on, even though the market is healthy. Okay, well, am I doing too many long-term contracts, right? A flip is a long-term contract. Here's the crazy thing about a flip. The money person, the lender, the investors, they get paid back no matter what, right? They have liens, they get paid their commission at the top, right? The title company, the realtors, like they all get paid back no matter what. The only person that either sinks or swims is the flipper, is the person that's doing that. So one, that's a lot of risk for us to be on ourselves. And then two, if we're using these same resources, going out and getting a deal, finding the deal maker, underwriting the deal, underwriting the construction, doing a budget timeline and all that, like, is there a way that we use all these resources, marketing dollars to find deals, our construction knowledge, right, all that, is there a way to kind of package something up, right, as if we were going to buy it, and now we know, hey, these are good numbers, I would do this, and we kind of wholesale or sell a few more, right, than we would take on to somebody else. Now we're using the same processes that we would use to do it ourselves, but we're packaging this deal up and just sending it out to somebody else, selling the paper, selling the contracts. This isn't new stuff, but I just mean, if I'm going to do 5 flips at 20 grand, right, or I really focus in hard and strong and get a good deal that's maybe the worst house in the best neighborhood, and it might take more marketing dollars to find and a little longer of a process. But if I did one of those that gets 100 grand, right, versus doing 10 ones that get 10 grand, right, now if I sold 9 out of 10 of those ones, it's going to be 10 grand, right? Or negotiate them down a little further, sell the contract to somebody else. Now, if I go to those ones that are really solid houses that we're just able to kind of get a really solid deal on, now if I sell more of my contracts and I only do the ones that are the lowest risk, right, and maybe they don't have bathroom additions and all that really takes a long time in permitting, now I've mitigated risk because it's not necessarily a residual stream, but if you have the chance to make money up front on a deal, right, or utilize the what a lot of people do and utilize their lending to now broker deals, 2% here, 2 points, 1 point here. Now we're using these things we built, financing, funding, and relationships with lenders that all have kind of a different thing, and we know what their new thing is. We know what we like on our deals. Well, what if we package this up? Well, we can sell the lending of the one that makes the most sense and broker that. Okay, that's a way to get paid on a deal without having to flip the whole thing. So it's this idea of just flipping the best one, using our other resources that we're already doing, our other marketing dollars, our other team that we're already using, and just change the product just a little bit so it mitigates that risk, so we don't have to be paid on the full life cycle of the deal. We can get paid up front for that deal and not even have to really take it on. So that's one way. The other way, on the residual income stream, right? If you want residuals, which I think everybody should have. I was doing single family rentals, and I'm just saying, I know everybody says it, but for me, it was just like the AC went out, the dishwasher went out, the dryer went out, or the washer went out in one house. And then the other person left and had an eviction, and all that. Well, had an eviction, hadn't paid for 3 months. So it's like these two houses that got like, well, one was $1,500, it was our old house, and one was like $500 a month, right? When all of a sudden you take into consideration now there's like 10 to 15K, and the air conditioner went out, that's $7K. So $7K, one owed $10K in back rents, and then washer, dryer, dishwasher. Like, it was like a $15,000 bill, all in 1 month, and it was just like, whoa, okay. So like, now I get it why people say like that there very much is, the rental game is like the varsity, right? The wholesaling, flipping, that's like, the freshman and JV kind of thing that you could do. I think that was Jerry Norton that said that too, and I can relate, because if you don't have, and it's funny because we think we're building that residual income stream, but when you're relying on it for that income that's coming in because you have bills to pay, now you're over leveraged, right? So if that person who makes a great W-2 can buy a rental property at 20K down, and it's nothing for them to pay the mortgage, right? That's probably somebody who's going to be well at doing like single family rentals, right? But if you're flipping and doing things and it's a part of the income that you have coming in, and you don't have reserves, right? Or like minimal reserves for it. If something happens, it's going to be very dangerous, right? Because you go pay that, and then you don't have somebody in for a few months. It's like you start to miss payments. It's going to be a very dangerous situation. And then flips get pushed out, and like nothing's coming in, and you have mortgages to pay, and you have evictions. It could be a very dangerous thing. So what we're looking at to mitigate that is using the same resources that we already have: marketing, acquisitions, underwriting, construction knowledge, right? These same things that we're doing to find single family rentals, if we just turn to over 30 units or over 50 units, now by really changing and transitioning what we are going after, we totally change the risk profile by finding a good deal. We know the construction, we know how to underwrite it. A team is involved, so the team is going to say if that's a good deal or not before they buy it. We get a percentage because we're the one in the front lines doing the acquisition, so we get a 1 to 3% acquisition fee. So now this residual income stream is protected by an immediate payment to our company for the work, protected by more people verifying the numbers on this deal, more money in asset management, in a CapEx account, and all of that, because when you buy something in the millions, you're going to have an account. You're not reliant. It has an occupancy rate. You're going to continue with that rate and just kind of renovate the rooms that get open in that time frame. You're not ever going down to zero occupancy. So we really have found that, like, if we just use our acquisition skills and our relationship building and our software that already goes and looks for single family rentals, that now we can pay ourselves in the front end by knowing construction, and knowing the process of renovating, managing the construction on our own deals. We can asset manage, right? With the help of our sponsorship group and our team, we can get paid for that acquisition fee. So now my project managers have an income stream that's coming in, and they're already doing the same thing for the flip. So now they can just focus on also adding this multifamily to their list, and it makes sure that they're always paid because we're getting 3%, 4% per year on that deal. So if we had 5 of those deals, right, there's a total fund for a great 1 or 2 project managers, and it just pays for them, right, a whole time. So our company's paid on a high level acquisition where if it's in the millions, I mean, that 1 to 3 acquisition fee is pretty large. And as long as we just keep the relationships with our sponsorship groups that we have, that we know want to buy where, and we just don't fudge the numbers or try to make something work that's not there yet, then we're going to be in a good place to bring deals to the right people, and potentially not even necessarily being on the purchasing side of those deals, but just bringing it to our groups. And even if we step out of it because we don't want to take on too many and only kind of get into the ones that make the most sense for us, depending on that sponsorship group, we could really maximize our time by doing one of these, every month or every quarter, and really bringing a good deal to the people that don't want to spend a lot of time negotiating. And we're already negotiating and talking and marketing anyway, so it just lets us change the one thing, which is the asset class, do the same amount of time, the same amount of things that we're already doing, and just shift into something that has a residual income stream. Because if you do a complex or an apartment building, there's that income coming in monthly too if you're on the purchasing side. So it lets you now mitigate that risk by transitioning to, you're doing something, you're already doing it, you just changed from single family to multifamily, right? Which I know sounds easy. It's not as easy. There's a whole underwriting process. But I've found I'm in some groups, I'm in some masterminds, I'm in a lot of things that also do help us in that way. And there's a lot of now people working behind us and next to us that can review and check our numbers out. And so there's a lot less risk in it too, because we have that team aspect too. So transitioning and changing what we're doing into something that's a better fit for us into the future. And also, man, I'll be honest, I stopped having that passion for single family rentals and Airbnbs and stuff like that, just with the sheer amount of time and energy and everything that it took from me. I realized this is not it anymore. I loved it. I did, having a few rentals, a few Airbnbs. I loved it. I did. But the calls, the damage to the property, the, loss of rents, all of that stopped really being fun for me. And it started really, being frustrating. And so I was already in the masterminds with the multifamily people. I've already talked to them. I've raised money from them on other deals. The other side of things in working with a bigger team that really is not forward facing to the property. There's a group that handles all of those properties, right? There's a management company, there's a property management company. So you're never getting calls direct from that property. And you can pay yourself for the acquisition, and you can pay yourself for the asset management, and be on the equity side. I just think it's very much worth our time to spend on those things, to wholesale a few more deals, to really take on only the best ones, and just kind of do the same things, but just shift a little bit into how we manage our risk of not being so over leveraged on how it works out in the end, and get some of these residual income up front. And once we start to see that coming in, then we could start to build the company out based on those numbers that we start to see. So we're starting with a goal to do 10K per month, from wholesaling deals. And then we're trying to do one multifamily every month too, to give us, anything over 30 units, Midwest, Northeast, that Kentucky, Louisville, Ohio, Cincinnati and Columbus, Ohio, to like Pittsburgh, that area north, that big circle in the middle, Tennessee, those places, and then the East Coast, so those kind of 3 areas, and we'll build relationships with brokers and some people like that. We've already built out our bio. Who are we? What makes us successful? That we're a long time negotiator, marketers, underwriters, and now we're just focusing on bringing better deals to our sponsorship groups. Bring better deals, have good relationship with sponsors. So just like a broker's the forward-facing side that goes after the owners, we're the back-facing side that's like going after and talking to more brokers, groups, knowing what they want, building that buy box, and really going and finding that for them, so we can just constantly be out on the negotiating side and be the one building those relationships with brokers and kind of managing that side of the relationship. So again, big on risk mitigation. I said the same thing in the other podcast. Big on risk mitigation. And you gotta laugh at yourself. You can't take yourself too seriously ever. You gotta enjoy what you do. That's a big part of this whole thing. And anything that starts to give you that panic, that anxiety, that really stressful feeling that makes you kind of wonder if you're in the right thing, it's good. And I think everything's going to do that. But when it's too much, maybe there's just some little things that you can shift, or little things that you can go after and really bring back that enthusiasm and that passion for what it is that you do. You just may have kind of shifted and got into the wrong thing, or realized you just didn't, when you finally were in it, that you didn't love it. But always start, narrow it all down, start with that one thing. When you start to really be in it for a while and you have all these relationships and you really start to look at what it is, then you can focus on where the risk is, where the problems are, where the energy is not flowing correctly, and maybe shift some of those things. And it might bring in some bigger income streams, residual income streams, and it might bring in just a bigger shift into things that have more upfront costs, as opposed to waiting months and months and months and having just a lot of factors need to take place for you to get paid and get paid correctly. So hopefully this helped in terms of just diversifying, mitigating risk a little bit, and maybe just shifting 1 or 2 little things that you're already doing and you already have resources for, that just might have a deeper impact and change and transition some of the way that payment is structured back to you in a way that helps make your company more profitable, less risky, and less reliant on of long-term revenue streams and long-term contracts that might over leverage you a little bit too much. So that's what I've really been focusing on now. It's kind of why I didn't post anything this last month, but figured I would really help you out. It's something that I've really been doing a lot of thinking about, and it's been challenging. It's really challenged me to the core, and I finally said, okay, I'm going to start listening instead of going headfirst at a problem that might not be making an impact on it. Instead of hitting this oak tree in a million different places, I'm just going to hit it in one place, and I've found the place that I want to hit it at. So I'm following that flag, if you will, from a movie we just saw the other day, the wife and I, on my Saturday rest day yesterday. So happy Sunday, y'all. And if you're listening on another day, happy day today. Go out and do things and do them great. And if this helped you out, please like, subscribe, share with somebody else if they're in the real estate industry or they've been in it for a little while. Sure, you can go out and listen to Grant Cardone or Bigger Pockets or anything like that, but somebody who might be right there, right in front of you, and is walking through some problems and giving you some real world advice about what to look out for to be more successful. That's what you get right here. So that's why I do it, y'all. And thanks for being here. Like, subscribe, share with somebody else. This is the Real Estate Renovator channel, and this has been a podcast about real estate investing and where we're at now. Peace.